here's everything you need to know about the outside days buy spike report on edgeful.com. So here we're looking at YM, the outside days report. We're looking at the last 6 months in the New York session. This session is going to be really important. So first of all, if you want to know exactly what an outside day is, go to the standard report here, number 7. We're going to be focusing on the buy spike, but you can go to the standard report, scroll down, and make sure to watch this video. If you also want to know how the sessions work, go over here, click on this one. That will show you how the sessions work. Super important that you guys understand that. And then we also have a full tutorial of edgeful on the homepage. You can see these 3 videos that will cover everything you need to know, how to use edgeful and all the features, how the sessions work, and then the ultimate bullish setup over here. So let me go back. Let me go to the buy spike here. And I am going to touch on what an outside day is, specifically in the New York session. And if you want to see this on London session, you can look at that across the board. This also applies to stocks, Forex, crypto, and futures. It does not matter. Everything is the exact same. For stocks, it's just going to be always the regular trading hours, 9:30 to 4. For everything else, it is the session that you have selected, which in this case, we're going to be looking at New York. So right now, I'm looking at YM. You can see these blue boxes on my screen. These are the New York sessions. If you want access to this indicator, this is an edgeful indicator. Click over here on the right side. The trading view access, you can see you need to put in your trading view username. You can find your trading username by clicking the profile button. Right over here, you can see my username is edgeful. Yours will be something else. Then you go to your indicators. You'll see all of them appear right here. The market sessions is the one that we want. Now, an outside day is when price today in this session, today's New York session, opens above or below the previous New York session's range. So you can see here, New York session high. I'm going to plot it out right over here. New York session low is right over there. And today opened above, obviously, previous session's high. Now, when this happens, this is called a bullish outside day because price opened above previous day's high. Now, we have bullish outside day. And if you want to know how often price retraces back into this range, go to that standard report. You'll be able to see that. We have a bullish outside day spike, and down here we have a bearish outside day spike. Now, it's very important that you know that this report only measures the outside days that reversed or that went back into yesterday's range because it is the relevant information you want. If price never came back down and it ran all day, that is not the information you want. In this case, this is for the reversal pattern, reversal strategy to take the move back into yesterday's range. So what this report specifically measures, now we're looking at YM, we're looking at a bullish outside day today because it opened above yesterday's high, previous New York session's high. And what you can see here is that when you go from the open, so I'm going to use my measuring tool here, you're going to go from the open to the high of day. I'm going to zoom in here a little bit. High of day made before price retraces back into this range. So you can see the average spike. So again, the spike is from the open. So the way that we actually do this, just so you know, we take the opening price, we take the candle that retraced back into the range, which is this one here. And then we say, what is the high of day on a bullish outside day, so the move against you, between these 2 points, which is right here. So what this is looking at is from the open to the high before price came down. So theoretically, this is the drawdown that you should expect, the average drawdown that you should expect if you enter right at the open short. Now, obviously, some days will be more, some days will be less. In this case here, this day was more. This is the average. Obviously, you need to keep that in mind. 90, roughly 86 is the average, which means that there are some days that are higher and lower. This is the single highest day here, this black one here, is the maximum spike in the last 6 months. So this is the highest that it's been while coming back into yesterday's range. Really important that you know that. So the way to apply this is to use this report as your entry and your stop. There's 2 ways really to do it, But if you are going to use, if you're just going to enter short right at the open on a bullish outside day, expecting it to reverse, you have to leave. So I typically would say if you're going to do that with lighter size. But you have to leave a wider stop because you know that on average, price is going to bounce at least roughly 90 points against you. The other way to use this is wait for price to bounce that average, roughly 90 points, and then now you can start to enter short up here, instead expecting the reversal because now you know that price is going to bounce in this case. And then to be honest, I don't like to leave stops based on arbitrary R multiples. You can use some level of support or resistance. It's maybe some level that you've had from a prior session or something else. Hopefully you have your levels, your supply, your demand, your support, your resistance, whatever else, which would ideally coincide with something like this. Like even if we try to do this for a second, let's just do this really quickly. So in this case, hopefully I'm trying to like obviously find an example in hindsight, but if there is some sort of level of demand or some zone here that you have that would coincide with a stop loss in this area, that would be a great ideal situation. Now, obviously in this specific example, we just plotted this out, but pretty much if you have some level of resistance or some level of supply or something where price can come in and reject for continuation downwards, that would be great as a confluence, just because personally, I don't love saying, I'm just going to risk 20 points or I'm going to risk however many points. Usually that is based on a P&L, and I don't like to recommend anything based on a P&L. I always recommend put your stop where your trade idea becomes invalidated. Now, you can say, I'm going to risk 25% higher or maybe 50% higher than whatever the average is, because I know that some will be higher, some will be lower. In this case, if you have it exact, if you have like an 86-point stop, you're going to get stopped out of some trades. Now, it is more conservative, but you are going to get stopped out of some trades, which is fine, obviously. But I just wanted to mention this, that the buy spike report here is exclusive, number one, to days that were traced back into yesterday's range. And then you can use it as an entry and as a stop. So the last thing is looking at the dollars versus percent. To be honest, I like percent more, but people like to use the points. So percent, by the way, would be right here. If you do the 80 something or just the 0.2, you can see 0.2%, 89, it's roughly the same thing. So just depends what you like to look at more. Just keep in mind that the percentages will scale more accurately. So if something goes from trading at 5,000 to 10,000 in the last year, or something like NVIDIA going from 500 to 1,400 in 1 year, that's where the point increments can get skewed, but percentage always scales. And yeah, that's pretty much it. I hope this is helpful. Please subscribe to the YouTube. There's a ton of free information for you guys on there. Appreciate you. Have a good one.